Over $500 million vanished into thin air, igniting the first crypto winter. It wasn't a bank heist, nor a government seizure. This was the collapse of Mt. Gox, the world's leading Bitcoin exchange, a financial black hole that swallowed fortunes and trust, leaving behind a crater in the nascent world of digital currency. Before its spectacular implosion, Mt. Gox was synonymous with Bitcoin itself. For many early adopters, it was the only real gateway to buying and selling the revolutionary digital asset. A wild west, certainly, but one that promised untold riches. Its origins were, surprisingly, not in finance at all. Mt. Gox started in 2007 as an online trading card game exchange Magic, the Gathering online e-exchange. Its founder, Jed McCaleb, a programmer with a penchant for digital innovation, repurposed it for Bitcoin in 2010. By 2011, McCaleb had grown weary of the exchange's operational demands. He sold Mt. Gox to Marc Karpels, a French developer living in Japan. Karpels, a man of considerable girth and quiet demeanor, inherited a platform that was growing at an explosive, almost unmanageable rate. Under Karpels, Mt. Gox became the dominant player. At its peak in 2013, it handled over 70% of all Bitcoin transactions worldwide. Imagine a single stock exchange controlling nearly three-quarters of the global market that was Mt. Gox's scale. But beneath the surface of this meteoric rise, systemic issues festered. The platform was built on legacy code, a patchwork of old systems struggling to keep up with the immense transaction volume. Security was rudimentary, customer support abysmal. Early warning signs were dismissed as growing pains. In June 2011, a hacker exploited a weakness in Mt. Gox's security, stealing 25,000 bitcoins and manipulating the price to 1 cent. It was a temporary dip, quickly recovered, but a terrifying precursor. The operational chaos continued. Users reported frequent delays in withdrawals, unfulfilled orders, and unresponsive support. Karpels, despite his technical background, seemed overwhelmed, often working from home, detached from the day-to-day operations. The Mt. Gox headquarters in Tokyo was a far cry from the sleek, modern offices of Silicon Valley tech giants. It was a small, cluttered space, reflecting the ad hoc nature of its operations, hardly inspiring confidence for a company handling billions. Then came the transaction malleability issue. This wasn't a new vulnerability, but a known quirk of the Bitcoin protocol that, when exploited, allowed transaction ID to be altered. This meant a hacker could make it appear as if a transaction hadn't gone through. In late 2013 and early 2014, attackers began to exploit this. They'd request a Bitcoin withdrawal, modify its transaction ID, then claim it was never received, prompting Mt. Gox to send a second batch of Bitcoins. The exchange was effectively double spending its own assets. Mt. Gox's internal systems, already struggling, failed to properly track these duplicate transactions. The exchange's Bitcoin reserves were being drained, slowly but surely, without anyone fully understanding the scale of the hemorrhage. The public facade began to crack. On February 7, 2014, Mt. Gox paused all Bitcoin withdrawals, citing technical issues. Panic rippled through the crypto community. The price of Bitcoin plummeted from over $800 to under $100 in a matter of days. Karpels insisted it was a temporary measure to fix the malleability bug. But behind closed doors, the situation was far more dire. The exchange was bleeding money. An internal audit revealed the devastating truth. Over 740,000 bitcoins were missing. At the time, this amounted to approximately $470 million US. Combined with $8 million missing fiat dollars, the total loss was staggering. $500 million gone. It was an unprecedented financial disaster in the digital age. On February 24, 2014, Mt. Gox officially suspended all trading, and its website went offline, displaying only a blank page. The next day, it filed for bankruptcy protection in Japan. The dream of easy crypto riches had turned into a nightmare. The aftermath was chaotic. Thousands of users, from small investors to early Bitcoin whales, lost their life savings. The incident cast a long, dark shadow over the entire cryptocurrency industry, fueling skepticism and regulatory fears. Investigations revealed a grim picture of negligence, incompetence, and potentially outright fraud. Karpels was arrested in August 2015 on suspicion of manipulating data and embezzlement. though he maintained his innocence regarding the missing bitcoins. He was later convicted of data manipulation, but acquitted of embezzlement. The court found that he had merged his personal accounts with the exchanges, but not that he had intentionally stolen the bitcoins. A murky distinction, perhaps, for those who lost everything. In a twist, some of the missing bitcoins were later found. Carpels discovered an old wallet containing 200,000 bitcoins in March 2014, hidden in cold storage. A small consolation, perhaps, but a significant amount that complicated the bankruptcy proceedings. The MT. Gox collapse stands as a brutal cautionary tale. It highlighted the critical need for robust security, transparent operations, and proper regulatory oversight in the burgeoning crypto space. It forced the industry to mature or risk further catastrophic failures. Today, former MT. Gox users are still awaiting full repayment over a decade later. The legal battles drag on, a testament to the complexity and long-lasting impact of this historic digital financial disaster. The MT. Gox implosion serves as a stark reminder. Even in decentralized finance, human fallibility and centralized points of failure can lead to ruin. Explore how the hunt for a vanished founder led to another crypto collapse in our next deep dive.